is the Dow over that period. See, starting in August '79, the first Chrysler restructuring, going through October '87, Black Monday, and see things really start to change around the time of the Netscape IPO, with the Dow really taking off, and that conceivably was sort of a watershed moment. The Netscape IPO priced, I think, in the teens, and it closed in the 80s or 90s. It really blew open Wall Street for a lot of new companies, anyways, at that time. And you see the downturn, the tech bubble bursting, followed by what they call the golden age of private equity, and then the crash or the decline of 2008, 2009, followed by a fairly volatile climb up to the recent record highs. Through the 80s, first LBOs, dot-com, golden PE. 2013, I think a lot of people are expecting more activity than 2012. 2012, I think people were expecting more activity than 2011, but it didn't really work out. Concerns over Europe, what was going to happen with healthcare legislation. I think there's a lot of general uncertainty among CEOs and CFOs what to do. So not a lot of acquisition activity, although financing activity remained fairly high, but a lot of that was refinancing and pushing things down the road, extending maturities, not so much new deal activity. I think where we expect to see some activity in terms of either restructuring or consolidation, healthcare, again because of the impact of the recent legislation, aerospace and defense, in part because of cutbacks in government spending, financial institutions, government contracting again because of cutbacks in government spending, transportation. Stocks going up in large part because of Fed stimulus. Corporate profits are also strong. Economic fundamentals aren't that great if you look around, I think. There's a lot of liquidity out there. The Fed is printing about $85 billion a month. It's comes to over $1 trillion a year, increasing their balance sheet pretty radically. So there's a lot of liquidity, not a lot of yield alternatives, so money's looking for places to park. Europe is not quite as dire as it was, although it remains to be seen how that really works out. No hard landing in China, at least not according to the party line yet. Debt ceiling has been diffused somewhat, and the budget deficit is not running as high as it was anticipated, but the long-term fiscal problems, structural problems around entitlements has not really been solved. U.S. housing rebound is questionable. Whether that's driven in part by large institutional investors coming in and buying up a lot of inventory to rent out, or whether that's really being driven by fundamentals remains to be seen. As far as the debt markets, they're fairly active. High yield is strong. Leveraged finance is strong. Again, a lot of that's refinancing activity, although I think there's probably been some increase in new LBO activity. The recent Fed stress test had only one failing grade that is Ally. Tier 1 capital is still rising. Bond and share prices of the major financial institutions are recovering. So there's fairly easy access to capital markets for companies that do want to borrow, especially for stronger credits. Larger banks are looking to grow. Regulation has cut back a lot of their more profitable fee opportunities. Housing and mortgage activity is not the profit center it used to be, and a lot of the banks have been forced to get out of or reduce their principal investment activities. There's been a bit of a bifurcation in the lending markets. Stronger banks that were bailed out but have improved their capital capitalization, are more able to deploy capital and originate loans, and they're even getting back into the cash flow lending markets again for higher quality companies. The weaker banks are a little more reticent. They're still concerned about capital preservation. They're not able to do the same levels of dividends or share repurchase of the healthier institutions, and so they're a little more conservative in their lending. And this just shows the concentration of assets in the larger institutions, those above 10 billion in assets over time. And you can see the banking sector has become increasingly concentrated. As far as headwinds in the economy, business and consumer confidence remain tepid at best. Remains unclear how healthcare is going to impact businesses and the economy overall. There's still some political uncertainty or political gridlock, for lack of a better word, in the U.S. Some uncertainty remains over Europe. Asia looks probably a little less uncertain than it was just 6 months or a year ago. The average Walmart consumer, the average person in Main Street America is still facing a challenge, whether it's employment situation, cost of living going up. There's a massive unfunded public pension mess that, depending upon the estimates, runs into into trillions of dollars. And also a private pension underfunding remains a fairly serious issue for private ERISA plans. That's me. See that? So that's kind of my introduction. I think I'll hand it over. In terms of questions, what are you guys seeing in the capital markets in your businesses? Do you feel like activity has picked up in the past year to date, 2013 versus 2012? What are the trends you guys are seeing?